So perhaps we can go through our stock selection process. So that's the science part of it. So we start with this financial strength of the companies. We want companies that have higher return on capital, that have grown their earnings per share, that also at the same time have a strong balance sheet. So the debt to profit ratio, usually we want something like less than 4 times. And we want a business model that is very solid. So we want companies that are market leaders, that have competitive advantage and low cyclicality. And the competitive advantage is very important, and I'll go back to that point a little later. The management team, so we want the CEO, the CFO, the high management team to own lots of shares in the company. So you want a high level of ownership. So they're really in the same boat as we are. We want managers that have good capital allocation skills. They make constructive acquisitions, and they really think long term when they make investments. And then we add market valuation. So we want a stock that will purchase at a level that we can double our money over 5 years, which is something like 15% annual return. So without being very precise, because we know that probably it's an illusion when you try to be too precise, we try to have a view of what we think the company can earn in 5 years. And it's going to help us to modelize what kind of valuation we can expect during that time. Few words about art. First, I want to say that art and beauty are in some ways interrelated. And very few money managers talk about beauty, but I think it's important. How do you define beauty in the investment? Well, we say that beauty usually to our eyes is something that is rare. We usually find something beautiful when it's something that we seldom see. So, and something that is unique is we never see. So it's really the rarest of all the beauties. And I always, sometimes when I read an annual report and look at the numbers, when I have this feelings, well, this is a beautiful company. It earns high return on capital. It has much better margin than their competitors. There's something that lights up in my mind. So what you want is to find what I call masterpieces. And they have one quality. They're rare and unique. So I've taken some example in the art world. So the Mona Lisa, a Rothko painting, a Vincent van Gogh painting. And if you want to take some example of business masterpieces, well, I've gone through the history of the capitalist world, mostly in the US. And, we can start with probably one of the first technology company in the 1880s called National Cash Register. That's probably heard of Hewlett Packard that many years ago was a very innovative company. Apple, IKEA, TG Maxx, Geico, the insurance company owned by Berkshire, Washington Post, H.R. Block, Dun & Bradstreet, Gillette, McDonald's, Starbucks. I think all these companies, and we could certainly add Google to that lot, these are business masterpieces. So you want to study those kind of businesses and see what do they have that was so unique. And usually the uniqueness in either the product or the service or the culture is equivalent of having a moat that protects your castle, your economic castle, from invaders, which, are competitors. So that's the key thing. You want to own a moat with lots of crocodiles and piranhas in it. So, competitors don't want to come near your castle. So if we could resume kind of what we look for in a company, it's really 3 things. And the competitive advantages, which we could say is the artistic part of that, the financial strength, which is really the science part, and the management team. And this is where judgment comes into play. It's very important to be able to judge management. And, that's kind of subjective thing when you talk about judgment. But, I always say, I have this phrase that when you meet the management, you ask yourself, would I like this man to marry my daughter? And if the answer is yes, it's probably a good man to be partnered with. So we end up with something like 125 stocks that fit our criteria. And the ones that we do buy for the portfolio are the ones that fit our criteria in terms of market valuation, that we can buy at a price today that we hope we can earn something like 15% going forward yearly. So perhaps just take a few examples to illustrate our approach. Well, one company I think is very unique is Walt Disney. They have great brand name. They own the Star Wars franchise. They own, of course, all those historical stars like Mickey Mouse and Winnie the Pooh, and they bought Marvel a few years back. And, I always say that Mickey Mouse has three great qualities. First, he's highly popular and known all around the world. Second, he's immortal. And the third, he has no agent. So you really own your star. And that's a great thing for Disney. And the uniqueness of business model of Disney is that they have these big movie blockbusters and like Alice in Wonderland in 1951. And then 50 years later, they can redo a new version and make money again with the same name. And they did that recently with the Jungle Book. They released their first animated version in 1967, and they did a real live version last year, which was also a big success. So it's kind of like owning an oil field where you take all the oil and 50 years later, you go back to the field and there's even more new oil to take out, and you don't need to spend money on capital and, pay people to guard your field. It's really an extraordinary business model. We bought that stock probably 11, 12 years ago. I think in 2005, we paid about $24, and it was the day that Bob Iger was named CEO. And we've done it since then. So there was a period when the stock did not do much. As you can see, for 4 years, the stock didn't do very well, but earnings kept growing, and we were patient. And if you look over the 12 years we've owned the stock, earnings have grown about 13% annually. And in the end, the stock has more than quadrupled. So if you're patient and companies grew their value, eventually the stock will follow. I want to take another example of a stock that's been a while in the portfolio, CarMax. It's been 10 years in the portfolio. And as you can see, earnings per share have grown at about 16% annually since we bought it in 2007. And the stock has done very similar, even though the P ratio is a little lower today than when we first bought it. We first bought it in the summer of 2007. At that time, the P ratio was about 24 times. We bought more shares in 2011 at 14 times, and more shares in 2016 again at 14 times. And today the stock is about 18 times earning. So even though the P ratio has been reduced a bit over the years, the stock has done pretty well. It's done about 13% annually, even though earnings grew about 16% annually. And that's about 5% better than the S&P 500. Dividend included has done about 8% annually over the last decade. So it's been a good investment.